Yeah, so welcome guys. Welcome each one of you to today's class. So in today's class, we're basically going to discuss regarding the credit decision and pricing. So under this, we have an important topic, that is, what are the pricing principles? Now, can any one of you may tell me what do you understand by pricing a loan product and why is it important? Anyone?
Pricing is important because that is the income for the bank.
Very nice. Anything else?
Pricing is decided basing on the risk.
Okay, absolutely. Risk is one of the foremost factors which helps us to decide the pricing. What else? Is there any relation
High,
between? Yeah, please go ahead, Bharti ji.
yeah,
Sir,
high competition in the market.
to
Okay,
maintain the asset liability management, sir. The
very
pricing
nice,
is
very
most
nice,
important for the spread.
very nice. So see, basically in every bank at the management level, basically they have an ALCO committee, Asset Liability Management Committee. Now, in the last class, we discussed that whatever deposits the bank is receiving from various depositors, that is basically a liability for the bank. Why? Because bank has to repay that money to the customer. In case a bank fails to repay the money, that will lead to a huge reputational loss. Right. So this is a foremost challenge for the bank, that whatever money it has received from the public at large, it has to return the same to the public with respective interest, depending on through which instrument or product the bank received that money. If the money was through a savings account, then the rate of interest applicable to saving account is to be given. If it was a term deposit, then respective rate of interest has to be given along with the principal. So this is one of the foremost challenges for the bank, that whatever money it has received, which is basically liability for the bank, it has to maintain a capital on it. It has to maintain and lend from these sources only. So it is important that bank is lending prudently. There are RBI guidelines which actually guide bank as to what prudent lending is. Reserve Bank of India has come out with various prudential guidelines through which RBI tells that you should not lend more than this much percent to a single borrower or to a single group or to a particular sector. So these are certain checks and balances which the Reserve Bank of India, being the regulator of the banking sector, has implemented. Fine. Now, like ma'am said, asset liability management. We said whatever depositors are keeping with the bank uses this money to lend further to the people who are in requirement of loan. Now, the major challenge is that the deposit may be for, if it is a term deposit, there is a particular tenure for which the customer has kept the money with the bank. Let's say it's a term deposit of 1 year, 2 year, 3 year, 5 years, right? So there is a specific tenure for which the money has been parked by the customer with the bank. Now, in case of savings account and current account, customer has this freedom that he can withdraw that money anytime. Now, of course, all of you know that bank is not paying any interest on the current accounts. These days, many banks, they have come up with a product like flexi fixed deposit, wherein even in current account, beyond a certain threshold, the system will make automatic term deposits, FFDs. And on that, respective rate of interest is given to the customers. But the advantage for having kept money in one savings account or current account for the customer is that he can withdraw that money anytime. So this is a major challenge for any bank, to keep certain amount of money in liquid form. That is why you must have heard there is a term called SLR, statutory liquidity ratio. Have you heard about it? Guys, have you heard about
Yes,
it?
sir. Yes.
Yes, sir. Yes, sir.
Right. So you see, again, RBI has made this as a guideline that every bank has to keep a certain percentage of their funds in SLR securities. Basically, SLR securities are highly liquid securities. And within these, treasury bills, they form the largest component. Treasury bills are short-term money market instruments. Fine, they are usually issued for a tenure of 91 days, 182 days, and 364 days. Now, again, let me give you some overview. You must have seen that, if government is not able to garner enough taxes, that means if the income of the bank is less than the expenditure then that it is making, then government has to borrow money. Yes or no? Yes or no?
Yes, sir.
Now, one of the options available with the bank is that it can either get its, large projects funded by banks like World Bank, ADB, IMF, or there are some other international banks. Number two, governments, they basically use something called fiscal deficit. That means they will ask the Reserve Bank to finance their deficit. For example, the expenditure was 125 rupees and the income was only rupees 100. So you see there is a shortfall of 25 rupees. Yes or no? Now for this, Reserve Bank will issue money. Reserve Bank will give kind of loan to the government. So every time the government is resorting to debt financing, basically it is taking more loans from Reserve Bank. And we also said that it can also take loans from foreign international financial institutions like International Monetary Fund, IMF, World Bank, ADB, right? But if a government is taking many loans, that is not a positive sign for the government. Just like we have a balance sheet for an individual or an individual business or a corporate, similarly, we have a balance sheet for our country as well, right? So if a country is taking too much of loan, that leads to too much of indebtedness, and that will lead to higher interest costs. So this leads to negative sentiments in the global markets. So the foreign institutional investors, they will avoid investing in such a country. Why? Because they have already taken too much of loan. They have very high interest payments. You must have heard that recently Sri Lanka was to be bailed out by IMF. Subsequently, Pakistan was to be bailed out by IMF. Have you heard this news?
Yes, sir.
So that was because they have taken so much of loan and their domestic economy is not doing well. Neither they are generating much through exports, that they are finding it very hard to service the interest liability on these loans. So basically, they ask these institutions to refinance these loans. Just like a bank will refinance a credit facility for a customer who is in a difficult time or is finding it hard to pay the installments, so may default. Same is with a country. If a country is having some internal problems, financial problems, and they may not be able to repay the interest as required, that will lead to what? Default. And to avoid that default, these countries, they talk with the respective lender for refinancing. Okay, and that is when the lender or these global financial institutions, they will modify the terms of their loan. They may say, okay, we are extending your repayment period, or we are reducing your sort of EMIs, that means the repayment method, but then you'll have to pay a higher rate of interest. So depending on how the negotiations go. So you see this thing happens even between countries. Just like you are an individual, you are in need of a loan, you may approach a bank, keeping in mind your credit history, your profile. Bank may choose or decline to give you the loan, right? Then you have to repay the loan as per the terms of the sanction. Now, same happens with a corporate. So basically, if a corporate wants to set up a business, which we call as greenfield enterprise, or wants to expand an external business, an existing business, right? So again, they'll be seeking some loan. Now, the lending institution will decide whether they want to lend for that particular project in that particular sector or not. Whether there are any bars in their existing institutions' credit policies. If they are, they cannot lend. So keeping in mind the bank's policy, what the regulator says, they may lend or they may refuse to lend. Now, again, as a corporate, he will have to ensure that he is repaying those installments as per the terms of sanction. In case default happens, again, the account may turn NPA and the bank will resort to legal recovery mechanisms. Or the borrower may approach the bank for restructuring of the credit facilities. You know that we are not able to repay this loan because of so and so circumstances, but we have the intention, so we request you to restructure the credit facilities. So it is the discretion of the bank, because even a lending institution would not want to simply let a good prospect turn into a default. So they may restructure a facility. And same is for a country as well. I have given you this idea that when a country as such is not generating enough income and its expenses are on the higher side, initially it will resort to taking loans from the domestic regulatory body, which in our case is Reserve Bank of India. So almost every country has a banking sector regulator, right? Now, even the Reserve Bank or the respective banking sector regulator for that country will give loan till a certain level. Why? Acha, can anyone tell me, will RBI ask government for any security before giving out any loans, or can Reserve Bank of India issue any loans to the government?
Yes, sir, they need to give a security, sir.
Okay, and what kind of security is given by the government?
Like bonds, RBI bonds.
Okay. Shweta, Divya, Manisha ji?
Not sure, sir.
Acha. Have you heard this term treasury bills? I just discussed, no? That treasury bills are a short-term money market instruments having a tenor of 91 days, 182 days, and 364 days. So you see, they are in multiple of 91. 91 into 2 becomes 182, and double of 182 becomes 364, right? So basically, treasury bills are only issued for these three durations here in India: 91 days, 182 days, and 364 days. Now, these are the securities which are issued by RBI on behalf of the government. And this is what is the security the government gives. So in India, what the government and RBI has done is that government has said that every bank has to invest in these securities. Fine. Now, every time Reserve Bank of India wants to give any loan to the government, that means it wants to print more currency. It will issue treasury bills. It is issuing on whose behalf? Government of India. And who are the buyers? Scheduled commercial banks are the buyers, because as per the regulatory guidelines, every banker has to keep at least 17.5% to 18% in SLR securities as on date. Am I clear?
Yes, sir.
Yes, sir.
Now,
Yes, sir.
again, for your knowledge, basically whatever assets the bank has, bank may choose to give loan, or bank may choose to invest that money somewhere. Bhai, Divya ji is a customer. Let's say she gave her 1,000 crores to me. Now I am the bank. I have received 1,000 crores from Divya ji. Now let's say she has done a term deposit. Fine. So whatever the tenor, whatever the rate of interest agreed upon, now the bank will be repaying this 1,000 crore upon its maturity along with the rate of interest. But the day this money comes to the bank, it is a challenge for the bank where to park this money. Why? Because this money is the raw material for the bank. If bank will not invest it somewhere, from where will bank earn the income? You see? So it is mandatory. It is a prerequisite for the bank that bank has to invest it somewhere. So bank must have some avenues. So we said loaning is one that bank can lend. So of course, the pricing that we have to offer on our loans has to be higher than the average cost of deposit. So if Divya ji has kept her 1,000 crore with me at 6%, so whatever loans that I'm going to give from this money should be higher than 6%. Yes or no?
Yes, sir.
Then I also have my operational expenses to meet. If I have a branch, I have to pay rent. If I have staff, I have to pay salaries. Then if I have infrastructure, I have IT facilities, then I have to pay for their maintenances as well. right? So let's say this comes to 0.25%. So now 6% is what I have to pay to Divyaji. 0.25% is my cost of, doing business. So again, the pricing should be at least 6.25. Yes or no? But then from where will I make the profit? So then I need to add some additional margin as well, right? So now I as a bank has different options where I can invest this money. I said one, I may offer this as loans, but for that I need to do credit analysis, credit appraisal. That means I lend it to a proper customer, a worthy customer who will be repaying this money. Now, what happens is many a times the economic situation is such that there is decline in the demand for corporate advances. That means the big corporate, they are not approaching banks for loans. So bank is not able to lend to huge corporate. So basically then it has to resort to small retail lending to retail customers, MSMEs. So this is one part that bank can use this money and give it as loans. Other option is bank can invest. The investment that bank has to make has to be within the regulatory guidelines given by Reserve Bank. So it cannot, invest its entire uh, portfolio into investments. Now, even within that, we were discussing about SLRs, statutory liquidity ratio. And we said that within that, every bank has to invest in treasury bills. Invest in what? Treasury bills. Treasury bills are government securities. These are part of money market instrument. That means these are short-term in nature. These are short-term in nature. That means only up to 1 year. These are part of money market. And they are usually issued for a tenure of 91 days, 182 days, and 364 days. Is it clear? Now, whatever investments these banks are making, basically these can be classified into three things. One is HFT, AFS. What do you understand by HFT? Anyone? Yes, please. Anyone? There is a term called HFT, there is a term called AFS, and there is a term called HTM. Bharti ji, Divya ji, Shweta, Rinshi, any idea? Vaishali?
No idea, sir.
Okay. Up till now, whatever I have explained, I hope you were able to understand that, each one of you.
Yes, sir.
Okay, fine. So I said that whatever investments a bank is making, as per Reserve Bank of India guidelines, the bank needs to classify them into three categories. The name of these three categories are HFT, AFS, and HTM. HFT means held for trading. That means these are those securities which can be traded by the bank. The other is AFS, available for sale. That means these are those securities which the bank can sell anytime. And third is HTM, held till maturity. Held till maturity. So let's say a bank has, out of this 1000 crore, just to give you an example, let's say bank has invested 400 crores in treasury bill of 91 days. Under what? 91 days. Got it? Another 400 crore under treasury bills of 182 days. Clear? And remaining 200 crore in treasury bill of 364 days. Is it clear as of now?
Yes, sir.
Out of the 1000 crores which the bank received from Divyaji, bank chooses to invest it in treasury bills, and it has invested 400 crores in treasury bill of 91 days, 400 crore in treasury bill of 182 days, and 200 crore in treasury bill of 364 days. Right? Now, even within this, the bank may choose what amount it want to hold on to till maturity of the security. That means, see, one treasury bill will mature in 91 days. That is why we say it is issued for 91 days. Another set of security will mature in 182 days. And another set of security will mature in 364 days. Yes or no?
Right, sir.
So depending on which security they want to hold on to till its maturity, that security will be classified under what category? HTM, held till maturity. That means these are those securities which are not available for sale, neither available for trading. Bank will hold on to them until when? Until their maturity. So if under HTM category, there is a 91-day treasury bill, then they will hold on to that security for how many days? 91 days till its maturity. If it is under 182 date HTM category, then they will hold on to it for 182 days. That means they will not sell it before its maturity. Got it? Is it clear?
After maturity, sir.
After maturity, they can sell it, no? Then second is available for sale. That means these are those securities which the bank has kept open. Bank can sell them anytime. This is to provide immediate liquidity for the bank. Yes or no? That if there is a major demand for any pre-closure or prepayment of demand deposit comes, then the bank will sell these securities for immediate availability of liquidity. Available for sale. So any security which is under the category of AFS, available for sale, bank can immediately sell them. There is no regulatory restriction. And third, I said is HFT, held for trading. These are those securities through which bank wants to earn income through trading. The moment we say trading, speculation comes into the picture. Yes or no?
Yes, sir.
So Reserve Bank of India has not given, unlimited freedom to banks. It has said that, okay, we understand you are a commercial entity. You have a business to run. You have salaries to pay. You have many other operational expenses. And you are a business at the end. So, we are within the regulatory framework. We are authorizing you that you can hold up to this much percent under AFS, this much percent under HFT, and this much percent under HTM. I hope this is clear. If you don't mind, if you could please ask your question again.
I was just asking, sir, so in the case of available for sale, who is the bank selling to? Is it other banks who will buy the treasury bills?
Perfect. Very nice question. So we said that treasury bill is a money market instrument. Okay. Let us understand the structure of the financial markets here in India. We have something called money market. We have something called capital market. We have something called Forex market or foreign exchange market. We have commodities market. We have derivatives market. We have insurance market. We have pension funds. Yes or no? Now, money market is a market where the securities are issued for a period of 1 year. Basically, we classify all the securities that are issued for up to 1 year as current liabilities, as short-term in nature. They can be current asset or current liability, but they are basically short-term in nature. If anyone wants to raise money from a longer source, where they want to issue the security for a longer tenure, then comes your capital market, what we also call as share market. Okay. Now, let's say you are a public entity and you want to raise money from public. So you will come out with your IPO, initial public offering. So for IPO, you have to list your company with one of the stock exchanges. You have to take prior permission of SEBI, right? So this is what IPO is. So, and whenever the company is raising money from the capital markets for the first time, it is called IPO. Now, after some time, if the same company wants to raise some more money, it will come with something called FPO, follow on public offer. or rights issue. Rights issue means that the company is giving this option to the existing shareholders that, we are allowing you to subscribe to our shares first before we come up with any other FPO. Got it? So usually there are certain selected participants in money market. Money market is overlooked by Reserve Bank of India, and it has allowed only selected institutions to be part of it. All the scheduled commercial banks, they are part of money market. Some all India financial institutions like SIDBI, NHB, they are also part of money market. And very few highly rated corporates. So basically, Reserve Bank can tweak or modify these guidelines whenever they want. But as of now, they have, allowed very selected entities to be part of money markets. Because through money market, these companies can, raise money for short term. So if a bank has excess of funds, it can lend them to some other bank who is in need of them. Right? Is it clear?
Yes, sir. Understood.
Have
Thank
you heard these terms? CRR, cash reserve ratio,
Yes, sir.
SLR, statutory liquidity ratio. So what RBI says that on every fortnight basis, banks, they must adhere to keep sufficient funds under CRR and SLR. If bank will fail to do that, then Reserve Bank of India will levy penalty. Okay. So you'll hardly see a scene where banks are not maintaining these on a regular level. Now imagine a situation where, let's say, Bank of Baroda has enough funds, more than enough funds. Okay. And it has surplus. It is seeing that it is going to have surplus towards CRR. Got it? And there is another bank who is facing a shortfall. So depending on for what tenure Bank of Baroda has that excess money, it can offer that money as a loan short term to the interested banks, participants of money market instrument. So the different instruments we have, one is call money. What is one? Call money. Then we have notice money. Then we have term money. Then we have these treasury bills, 91 days, 182 days, 364 days. Then we have instruments like commercial papers, certificate of deposits. These are some other instruments that are issued in the money markets. Guys, is it clear to everyone what are the different instruments or securities that are there in the money market?
Yes, sir.
Everyone?
Yes, sir.
Okay, just a moment. I hope you can see this. Everyone, please.
Yes, sir.
Now, this is the website of Reserve Bank of India. First, you see these are the policy rates. Can you see them? Bank rate, reverse repo, right? These are reserve ratios, CRR, SLR. Fine. Now, this is how the Reserve Bank will usually auction these treasury bills. Can you see this? 91 days, 182 days, 364 days.
Yes, sir.
So basically what government Reserve Bank is saying that, they are going to offer these many treasury bills for auction on these dates with these amounts. So you can see the total amount is 2,60,000 crore. Right? And this is for period starting July 1st, 2024 to September 30, 2024. Now, please understand that this is not directly related to your course or the content. This is being shared so that you get a comprehensive understanding of how these markets behave. what money market is, what RBI does. Got it? I hope this is clear.
Yes, sir.
Everyone, please.
Yes, sir.
So one small question, sir, in this.
Yeah.
So, how is it decided on what rate of interest one bank can borrow from the other bank? And second bit is, how will I know? For example, I have a bank and you have a bank, someone else has a bank. I have to sort of share that I need some treasury bills on some
No,
platform.
basically, ma'am, there is a platform. Yes, yes, absolutely. There is a platform where the dealing of all these securities take place. So only the entities which are allowed as per the Reserve Bank of India guidelines, only they are onboarded on that platform. And then within that platform, they can make use of various available options, which security they want to subscribe in, which security they want to sell. Right. So basically, we have a platform in the name of eKuber. eKuber. This is maintained by Reserve Bank of India. Got it?
Understood, sir. Thank you.
Yeah. Now, what I want to share, which is very important, is most of you may already be knowing, but this is the crux that you see under notifications on the Reserve Bank of website. You will see master directions, master circulars. So let us understand that, see, Reserve Bank of India is regulating the banking sector. In addition, also the foreign exchange markets, right? It also regulates the payment system through Payment and Settlement Act 2007. So, time and again, it will come out with various guidelines, and here you will find those guidelines. This is the notification. You can see this is the latest notification, June 28th. These are master directions. Relief saving bonds. You see? I hope you can see. Now, this circular is operational guidelines for primary dealers. We'll just click on this. Basically, primary dealers are those entities that have been identified by Reserve Bank of India, and they help banks or they provide markets for these treasury bills. Got it? Here you'll find that information. As of now, that is not relevant. So you see, like, what is the minimum capital requirement for operational risk? This is the investment portfolio. You see this circular? Classification, valuation, operation of investment portfolio of commercial banks. Right? See, banks shall classify their interest clusters portfolio. Three categories: HTM, held to maturity, available for sale, and held for trading. Is it clear?
Yes, sir.
Everyone, please. What about others? What about others, please?
Yes, sir.
Right? See, this is being shared because this is something that you should know. Although this is not directly relevant from the point of view of this exam, but understanding of this is very important. And that is why I showed you how to find this information. Here you will find many more details, which again are not useful for this particular examination. But if you are someone who want to have a, better understanding of all these things, then you can refer to this. So initially, when we started, we were discussing regarding the pricing, that what is the pricing principle? And then one of you shared that, banks have ELCO committees and asset liability management, which is very important for the banks. And this money market, this basically helps the bank in asset liability management. Okay. Is it clear, guys?
Yes, sir.
Yeah. So we were saying that, there are different banks, especially scheduled commercial banks, which are part of this money market. And under this money market, there are different ways through which a bank can either lend or borrow. And I gave you the example, let's say, out of 12 banks, for example, 3 banks have surplus of liquidity. They have surplus of funds. And there are few banks who are facing shortfall, be it in maintaining CRR or SLR. So now they can resort to borrowing or lending through these money market instruments. So if a bank sees that as per its asset liability management committee's report, they foresee that, for tenures ranging 100 days to 120 days, we may face some liquidity problems. That is when most of our deposits are maturing. So they may buy surplus funds available from some other bank. Basically, through this, they fulfill their mismatch requirements. Because a customer who comes and has given a deposit of 1 year, if he may want, he can withdraw the money even before the completion of 1 year, and bank has to provide the funds, right? Whereas when bank has given that money in the form of loan, the repayment would happen gradually, there is a particular repayment period. And on top of it, there is a chances of default, that many loans may not be repaid as promised. So this mismatch happens. So banks all the times have to work on this asset liability mismatch management. Is it clear?
Yes, sir.
Guys, the entire idea is to give you a comprehensive picture. I could have straight away gone and, started talking about term of loan, cost of capital, risks of premium. But what is important is that you understand as to what is happening at the background. That why bank has to be so particular before pricing a loan product. Because there is a lot many complexity happening at the background. The business in a branch may seem very normal, but if you look at the corporate level, at the head office level, especially when you have to follow the guidelines issued by the regulator, this is very challenging. And of course, very dynamic. Now, can anyone tell me what is a bulk deposit? Especially if you're working in a public sector bank, you must be knowing. What is a bulk deposit, please?
Sir, bulk deposit is a deposit which is offered with differential rate of interest as per the demand of the customer.
What is the quantum,
Quantity.
the size of that deposit?
More than 100 crores, sir.
Okay, basically, as per Reserve Bank of India guidelines, earlier it was rupees 2 crores. Now it has been made as 3 crore. Okay. So any deposit that is rupees 3 crore or more will come under what? Bulk deposit. 100,000, 5,000, even 3 crore, 3.01 will come under what? Bulk deposit. Now, usually banks, they are realizing that they should not rely lot on these bulk deposits. Because as and when premature withdrawal happens for these bulk deposits, this leads to a major challenge for the ALM management. Let's say initially a bank is holding 50,000 crore under bulk deposits, right? Let's understand it from the head office perspective, corporate level perspective. So on their balance sheet, on the ALM, they will see that, we are holding 50,000 crores under bulk deposits. Now, the problem with bulk deposit is that these companies, these corporates who have provided this bulk deposit, they may prematurely withdraw these. Okay. Now, if I choose to invest these 50,000 crores, where this money would be returned, repaid in a longer tenure, right? Let's say this bulk deposit on an average was for 6 months or 1 year. And if I lend this, wherein the repayment will happen in 3 years or 5 years, so can you see the mismatch? And on top of it, the risk is that these borrowers, these bulk depositors, they may prematurely withdraw the funds as well. Right? So just like around 2016-17, when the balance sheets of public sector banks was swelled with NPAs, the NPA levels were so high. Why? Because bank had given too many loans to the corporates. Right? That is when banks decided that we should diversify our risk. Instead of giving 100 crore to a single borrower, we should give 10 crores to 10 borrowers. So we'll be diversifying our risk. So similarly, banks these days are realizing that, instead of solely relying on these bulk deposits, we should find retail depositors or deposit, which we call as CASA, which is more stable. Why? Because cost of fund is becoming very important. Net interest income and net interest margin. These terms have become very important these days. So what banks are doing, they are trying to find cheap funds. So basically cheap funds come through what? CASA deposits. CASA is what? Current account, savings account.
Okay.
Whatever money a bank has in its current account and in its savings account, that is CASA. And it is called low cost deposit. And in last 2-3 years, what banks are seeing and what is happening in the banking industry is that this CASA ratio is reducing quarter after quarter for almost every bank, be it a private sector bank or a public sector bank. Now, the reason is that customers are becoming more aware. They are choosing to invest these funds in capital market, let's say through SIPs, in mutual funds. But what is happening is that these cheap funds, which were earlier available with the banks, subsequently these are, reducing quarter on quarter. Thus, that pressure on the interest margin is increasing all the time. So you'll see these days banks are coming up various products wherein they want to garner maximum CASA. They are coming with salary accounts wherein they are offering insurances, accidental insurances free of cost. Because the idea is to get cheap funds, as much CASA as possible. IDFC First Bank is offering zero charges. If you maintain 10,000 monthly balance or 25,000 monthly balance, they will not charge you anything. Nothing for SMSs, no charges whatsoever. So the idea is to maintain a high CASA. Why? Because it is a low cost CASA. So if you get the deposit at a cheap rate, you are in a better position to offer loans at in an attractive rate of interest. So let's say there are two banks, Bank A and Bank B. Now let's say Bank A has average cost of deposit as 6.90%, 6.90%, and Bank B has 7.05%. Which bank is in a better position to offer competitive rate of interest on loans? The one which is average cost of deposit is 6.90%, or one whose average cost of deposit is 7.05%? Yeah.
Its cost of deposit is 6.0.
Anyone else?
Same.
Yes, sir.
Yeah,
Low
same.
rate of interest, sir, which offers low rate of interest can lend with a lower
Very
rate of
nice. A person who's getting the deposits at a lower cost, 6.9, that business is better placed to offer competitive rate of interest on its loans. Yes or no? So banks, they have to compete with one another because customers are looking for lowest rate of interest. At the same time, they have to maintain profitability as well. And on top of it, we have something called NPAs, non-performing assets. The moment an account turns NPA, banks have to provide provisioning. That means they have to provide capital from their profits. They have to keep some money aside as provisioning. So that is why this credit appraisal becomes very important. And basically, the idea of doing credit appraisal, credit analysis is so that we can suitably and rightly price our products. Because bank has to take the risk. It cannot avoid taking that risk. Yes, it can mitigate that risk. It can take calculated risk and then it can try and reduce that risk. So how can a bank reduce its risks? Anyone? How can a bank reduce its credit risk?
Doing in-depth understanding of the risk profile.
Very nice. Basically, by lending prudently, by lending diligently. So if you are following the guidelines that are there in your bank's credit policy, if you're doing a thorough due diligence on the borrower, for that, you need to gather information as well. Now, you simply cannot rely on the information that is being provided to you by the borrower. The borrower may not provide you the complete information. The borrower may only provide you selective piece of information. But if you solely rely on the information being provided by the borrower, don't you think you may end up doing a false or incorrect credit appraisal? Because you didn't get the complete picture, no? The borrower has submitted his financials, and on the basis of financials, everything is fine. But when you actually make the unit visit and you see there are labor issues, there is not adequate raw material, right? There are security issues. Don't you think those are certain challenges that can cause problems in the future that may lead to account turning bad? If there are HR issues, if there are labor issues in a business, right? And let's say there is a manufacturing concern. Now, if those labor issues are not resolved in future, that may lead to strikes. Strikes may lead to lower output. Lower output will lead to lower sales. Lower sales will lead to lower profitability. Yes or no? And lower profitability may hamper that business's capabilities to repay the loans. Can you understand this? The thing that I'm trying to share.
Yes, sir.
Right. So similarly, there is something called credit information reports. Credit information reports. These are given by CICs, credit information companies. So basically, these are companies which are providing you information. What kind of information? Regarding the repayment history of a borrower, whether a customer has taken any loan from any financial institution. If he did, how was the repayment? Was he a defaulter? So again, this information is there to assist you to take an informed decision. Again, let's take two scenarios. There is customer A and there is customer B. They approach Bank X. Now, Bank X is able to draw CIBIL report or credit information report on customer A, but is not able to draw any information on customer B. Which is a better risk for the bank?
Customer A.
Yes, because they have some information on that. No. Now, if for customer B, if the score had been -1, that means no credit history. Even that would have been acceptable. Why? Because they can find out that customer has not taken any loan, right? But if the credit information report is not able to give any report, not even -1, then that becomes more riskier, right? Now, again, a person with a score of -1 and a person with a score of 800 or 840, which is better?
800.
840.
Yes, very nice. Both the customers with a score of 800 and 840 are better because, they have taken loan and their credit history is reflecting that they are good payers. They have not defaulted. They are maintaining a good score. Whereas on -1, again, the institution does not have any information because that customer has no credit history. So these are different tools available to a credit analyst, credit appraiser, on the basis of which they can decide. They are trying to quantify the risk. Why? Because ultimately they have to decide whether they want to lend or not. If yes, what is the possible risk? And how should they price the product so that they can compensate for that risk? See, we said banking and lending is all about taking risks, but we want to take calculated risks which can be quantified. Because only if we can identify and quantify the risk, we can take any corrective measures, yes or no? If you can't identify a risk, can you take mitigating actions against it?
No.
It's just like a bad odor coming from somewhere, but until you identify the source of that bad odor, can you take any corrective action? No, right? So lending is all about doing due diligence, and this due diligence is an ongoing process. Right from the application comes to you, that may be from a customer to open a savings account. Again, I'm repeating my question. Those of you who have already heard this question, please do not answer. If you as a bank are going to receive deposit from a customer, are there any risks involved for the bank? So I'm not talking about loan. I'm saying a customer is going to give you a good deposit. So do you think when banks are accepting deposits, this can also come with its own set of challenges?
Yes, sir.
What can be those challenges? What can be those challenges or risks?
Source of fund.
Okay, please elaborate a little more.
Like where from where the customer has received those funds.
A little more.
From
What is the risk? You're very, very close.
AML risk.
Very nice. Who was it?
Sir, me, Vaishali.
Yeah, absolutely, Vaishali. So basically, this is the biggest risk. In India, as of now, the banks, they don't take this very seriously. But if you talk about global banking, foreign banks, they are very particular about it. That is anti-money laundering, AML compliance. Even in India, we have this Act Prevention of Money Laundering, and it is a serious offense even here in India. But banks, they don't take this that seriously. In foreign banks, they have special verticals for it. These days, even our banks, SBI, larger banks have, right? But still, in general, the branches you'll go, they are not aware about it. So this is one of the major risks that, even when we are accepting deposit from a customer, we don't know what the source is from where that money is coming. Clear? Is it clear, guys?
yes, sir.
So that is why even when a new customer comes to you, when I say customer, this is applicable for every business, not only to banking. If you'll see this compliance is becoming more and more important. Now, just imagine I'm a real estate company and I have constructed some buildings, and a buyer comes and he purchases some property. Now, later on, it is discovered that he purchased that property out of the proceeds of some crime, or that was black money, or that was after tax evasion, or that was laundered funds. Don't you see there is risk? But as a businessman who's into real estate, I'm more interested in selling my property. I'm not caring as to from where that money is coming, right? But tomorrow, if this matter goes to court of law and it is established that, that money was from a fraud, so even the proceeds of fraud, they can be attached. So for us as bankers, especially for anyone who's working in the financial industry, this due diligence becomes very important. That we should know who the customer is. We should ascertain the beneficial owner as to who actually is controlling that organization. For this, we have covered in our earlier classes, every bank has a board approved KYC policy, know your customer policy, which has 4 pillars: customer acceptance policy, customer identification policy, risk profiling, and regular monitoring of transactions. The 4 pillars are customer acceptance policy, CAP, as to which all entities, which all individuals, which all businesses can be accepted by the bank or financial institution as its customers. Now, a terrorist wants to open a bank account. Do you think banks should allow open the bank account? A terrorist
No.
wants to open a bank account. Do you think bank should go ahead and open his bank account?
No, no, no.
No, sir.
No. Is he not a human being? Does he not have banking needs?
But he might use the bank account to.
Okay, this is just to check your confidence level. You will not open it because there are regulatory guidelines. If you heard about United Nations sanctions list, you know, UNSC, United Nations Security Council, and many other global entities, they come out with such lists. If any persons or business names falls in that list, then you cannot associate or have any financial relationship with them, else you will be penalized as well. Okay. So if there is a business which is into human trafficking, terrorist activities, money laundering, and if you know, then you will not open their account. Because it is your responsibility that you are not exposing your bank and the global financial institutions to these risks. Why? Because the sector is dynamic. An individual who's a terrorist or belongs to a terrorist organization may open the bank account with a bank in country A, let's say Pakistan. And since that bank was associated or connected with the global financial system, so the money will be immediately transferred. So the terrorist who opened the bank account with a bank in Pakistan, right, may end up sending money to someone in Dubai or someone in US. And the person who received money in US may use that money to carry on some terrorist activities like 9/11 happened. Yes or no?
Yes,
Yes
sir.
or no?
Yes, sir. They
Why,
can
it is
misutilize
just
the-
like you see water flowing from one pipe to another, being in different locations, but everyone wants water, they are interconnected. So if you add any poison on any wrong thing in that water, and if it travels to any other tap, don't you think that risk would be there? Yes or no?
Yes, sir.
So
Definitely.
it is the responsibility of every bank that is being regulated that they adhere to the regulatory guidelines. That is why you'll see we have something called Basel in Switzerland. We have something called BCBS, Basel Committee on Banking Supervision. We have something called FATF, which is a global regulatory body on money laundering, right? You must have heard that, you know, they have classified a particular country into gray risk. That means now that country cannot access global capital because there are risks if you invest in that country. As per the list given by FATF, it comes out with a gray list. Until last year, Pakistan was at that list. So no global investor was investing in Pakistan. Why? Because it was established that the banks in Pakistan, the financial institutions in Pakistan, they are not following AML guidelines, because of which terrorists and such organizations are able to access the global financial system. So you'll see how interesting it is. Although you may be in any bank, okay, it is your responsibility to follow your bank's guidelines, regulators' guidelines. So I said that the KYC policy has 4 pillars. First is customer acceptance policy. So your banks, your financial institutions KYC policy will tell you as to who all customers can be, or who all people, entities, businesses can become your banks or financial institutions customers. Fine. Then is customer identification policy. Then how do we actually identify this customer? So we will call for some proofs. Identity proof, PAN card, Aadhaar card, passport, address proof. For businesses, we will call for business proofs, GST registration, IEC code, FSSAI license, shop license under Shop and Establishment Act. So any registration proof that will show that this business exists, at least on paper. Then the onus lies on you to actually go and visit whether the business exists on that registered address or not. What if it is a shell company? Right? Then third is keeping in mind the risk or the profile of the customer or the business. You will classify the business individual on various risks. So let's say a salaried customer comes to you and opens an account. So that government salary customer becomes a low risk. Whereas if the customer is a PEP, politically exposed person, so he's a very high risk. If there is a businessman who's dealing in diamonds, he's a very high risk. Right? So you have to classify the customers on low, medium, high, very high risk. And then regular monitoring of transactions. This is the fourth pillar. So if you opened the account for a customer who is a low risk and the information says that he's salaried, and at the time of account opening, you got this information, maybe that this much would be his salary. So let's say the expected credit in a year was 50 lakh, right? We are assuming that his monthly salary was 3 lakh rupees. So 36 lakh is the salary and some other incentives, and also maximum in a year, the credit may come to 50 lakhs. But 4 months down the line in a financial year, you see that this limit of 50 lakh has already been breached. That means the account has already received more than 50 lakh rupees. Right? So your softwares will alert you. You will receive a red flag. Why? Because when you obtained the information, you got this information that he's salaried and the maximum credits during a year may be 50 lakhs. But now within first 3 months, the account has already received 50 lakhs. So you will closely monitor the account. Now there may have been a major amount of 40 lakhs. So you may inquire with the customer and he may say, I sold my property. That is justified. No issues. Or if you find anything suspicious, then you will find the suspicious transaction report, STR, with FIU end. Every bank has to do it. This is from the point of view of money laundering. Wherever you believe that the customer may be into money laundering, is evading taxes, then it is your responsibility as per the regulatory guidelines to report it through your bank's principal officer to FIU IND. Every bank at its corporate head office will have a principal officer. In most banks, he is of the rank of general manager. So they have to report all such suspicious transactions to FIU India, Financial Intelligence Unit India. This is a special designated government body under Prevention of Money Laundering Act 2002. I hope this is clear, please.
Yes, sir.
Yes, sir.
Right. So for you as a banker, even when you are receiving funds, it is important that you do necessary due diligence. Now, you may be in a mutual fund company. So even when you are receiving funds in a mutual fund scheme, in an insurance product, in a pension fund, similarly, you need to follow the due diligence process because you do not want unnecessary reputational or regulatory risks for your business. So again, coming back to our topic of pricing principles, we said that pricing has become important because bank is a corporate entity, so it wants to earn profit. Basically, they want to maximize profits. But the various challenges in the economy, in the financial system, is making this difficult. So now banks, they want to lend, but to quality customers, but at the same time, they also want to have quality standards of credit appraisal, credit analysis. Fine. And in pricing, some of the important points are term of the loan. So if you are giving a loan for 3 years or if you are giving a loan for 10 years, which is more risky?
10-year.
Yes. But now if you're giving a loan to a government employee who is salaried for 10 years and to a businessman for 3 years, which is more risky?
Businessman for
Businessman.
sale.
Yes, right? So you see how the nature of risk changes. You already understood the cost of the capital and risk premium. So basically, once the bank has quantified, calculated the level of risk they foresee in financing a project, so they decide as to how much risk premium they want to charge to compensate their bank for the risk they are going to take. So again, if it is a new business where the promoters are relatively inexperienced, the risk premium is going to be on the higher side. Why? Because it is a new business. So chances of the business failing are high. They are young entrepreneurs who do not have much experience. So that is again a risk. Fine. Whereas on the other hand, if a corporate like Tata, Reliance, or anyone who has been in the industry, who has business experience, you will see that they are relatively safer risks. So there, the risk premium that bank is going to charge is going to be lesser. Why? Because they are less risky. So guys, is it clear? If you have any questions, please let me know. Otherwise, this is it for today. Yes, please. And were you able to understand? Bharti, Divya, Bharti ji, how's your feedback on the class? Just want to
Yeah, sir,
understand.
it's good, sir. It's quite good, sir.
Right?
It is very informative, sir.
Yeah. You'll see that, we are providing you comprehensive information. Because
Yes,
I
sir.
told you, I promised each one of you that passing this certification is not a big deal. You just attend the classes and you go through the content, the mock questions that are there on our portal. Fine.
Yes,
But
sir.
if you continuously attend our classes, you will get a comprehensive understanding of the markets, of the banking sector, how things are interrelated.
Yes, sir.
Divya ji, what about you?
Yes, sir, it was clear, sir.
Okay. Rinshi, since this was your first class, please let us know.
Yeah, sir, it's, everything is clear and it's very informative.
Okay. You did understand whatever was shared in the class, right?
Yeah, sure.
Yeah. Prasanna, Shiva, they are regular readers. Yeah, Shweta ji.
Very helpful, sir. I understood everything that you shared, and it was a very informative class.
Nice. Very nice. Vaishali. So this is also a test if whether everyone is actually attending or not. Vaishali. Vaishali, you there?
Yes, sir.
Yeah. So what is your feedback?
Sir, it was a good class, sir.
Okay.
Very informative also.
Fine.